Welcome to Trend Watch. We can finally apply the fundamental knowledge we gained from tutorials 101 through 112 to interpret the most important chart in options trading, the option expiration profit and loss chart. Any option strategy, whether it involves a single leg or multiple legs, simple or complex, the expiration profit and loss chart for that strategy reveals important information, such as the expected direction, potential risks, profits, and break-even points. Therefore, the ability to interpret the expiration profit and loss chart is crucial for success in options trading. As always, we will start with the most basic form of options trading, single leg call and put options. The term expiration profit and loss chart refers to the profit and loss associated with that option strategy on the expiration date. We will cover another chart called the current profit and loss chart in a separate tutorial. The expiration profit and loss chart is more commonly used and is crucial in options trading. To help you better understand this concept, we will divide the topic into two tutorials. Before we delve into that, let's start with the profit and loss chart associated with purchasing a stock. The vertical axis represents profit and loss, while the horizontal axis indicates the price of the underlying stock. The profit and loss curve is a straight line with a positive 45-degree slope. The point where the line intersects the horizontal axis reflects the cost of purchasing the stock. In this scenario, a $1 change in the stock price results in a corresponding $1 change in the profit and loss for the stock buyer. Therefore, there is a positive correlation between the stock price and profit and loss. In contrast, when you sell a stock short, you are betting that its price will decline. The profit and loss curve for this strategy is a straight line with a negative 45-degree slope. This means that for every dollar the stock price rises, your profit and loss decreases by $1, and vice versa. Thus, there is an inverse relationship between the stock price and your profit and loss. We can apply similar concept to options. This is the expiration profit and loss chart of a call option with a strike price of $100. To simplify the understanding, we will first ignore option premium from the equation. The lines represent the profit and loss of this option. We can break this chart into three parts according to the strike price: out of the money, at the money, and in the money. For the area below the strike price, which is out of the money region, the profit and loss of this call option is 0 because it will expire worthless. You will not exercise this option when the price of the stock falls below the strike price. For the area above the strike price, which is in the money region, the profit and loss curve is a straight line with positive 45-degree slope. Every dollar up in the stock price will see a dollar up in the profit and loss. This is like holding on to the actual stock, and the maximum profit is unlimited. The expiration profit and loss curve pivots at the strike price, which is at the money level. One side from this point expires with profit, while the other side expires worthless. If you look at the profit and loss curve of the call option seller, we can also split that into three parts in the same way. Without considering the option premium, the seller doesn't make any profit or loss in the out-of-the-money region. In contrast, in the money region, the seller's loss will go up as the price of the stock goes up. At the money once again is the pivot. When you analyze the profit and loss curves at expiration for both buyers and sellers, you will see that they mirror each other. This occurs because options trading is a zero-sum game. One party's gain is the other party's loss. When you understand the profit and loss curve of the option buyer, you can also determine the profit and loss curve of the seller, and vice versa. We can apply the same concept for a put option. This is the expiration profit and loss chart of a put option with a strike price of $100. We will still leave out the option premium for this time. Similarly, we break this into three parts: at the money, in the money, and out of the money. The region to the right of $100 strike price is out of the money. Buyer will not exercise this option. There is no profit and loss as shown in the red line. On the other hand, the region to the left of $100 strike price is in the money. Every dollar drop in stock price will see $1 up in the put option buyer's profit. This is like short selling a stock. The profit and loss curve is a straight line with negative 45-degree slope. However, unlike a call option, the maximum profit for put option is not unlimited. The maximum profit happens when the underlying stock price drops to zero. So for this example, the maximum profit of this put option is $100. The expiration profit and loss curve pivots at the strike price, which is at the money level. One side from this point expires with profit, while the other side expires worthless. Similarly, we can then derive the profit and loss curve for the put option seller. We can see that the profit and loss for buyer and seller mirror each other for a put option, just like what has been described in a call option earlier. We have now covered the 4 essential profit and loss curves for options trading. It is important to familiarize yourself with these curves, as we will consistently refer to them in both single-leg and multi-leg option strategies. In the next tutorial, we will revisit these charts to examine one element we have not yet considered: the option premium. Thank you for watching.